Alright guys, if you stumbled upon this video, you found one of those rare videos where I do some technical analysis on the markets. So I do this for fun on the side because I like to trade and make money moves or whatever. So let's just jump right in. I do gold and silver a whole lot. That's kind of what I do. So here we are. Gold recently had a massive run up. Went to about 5,600. Now we're sitting at about, we took a bounce at about 4,000. We're sitting at about 4,600. So a lot of people are going to see, oh wow, we've gone down $1,000. Oh wow, we've gone down $1,400 in the span of about 50 days. But if you look at the 50 days prior to that, if we just go back about 50 days, so that's to here, and we measure, it's about December. Let's look at December. Even from just December, we're still up 10%. Okay, we're up 10% from December in gold. Now let's go look at the NASDAQ for instance. Since December, what has the NASDAQ been doing? Let's get so where are we? February, January, February, here's December. December 25th, that's about what I measured to. On the other hand, the NASDAQ has gone down 4%, roughly. So something interesting is happening. If you understand what's happening, it's very clear to me because I've been doing this a while, but what's happening right now is risk-off behavior. Now you can see the NASDAQ, since it's double top, we had in October 25 and then again in January of 2026. Since it's double top, the NASDAQ hasn't recovered and it's gone down about 8.29%. Now you got to remember the NASDAQ is 100, you can see up here, 100 stocks in the United States market. They're all mostly tech stocks. So on average, those 100 companies have gone down roughly 8% from their overall highs in what I think is a double top. Now, some other things are indicating that to me. If you see here on our MACD, we have strong trend here that's remained intact for about better part of a year and a half now. So the MACD, that's this right here, moving average convergence and divergence. Basically, it's kind of a way to visualize moving averages. So as you can see, our moving averages are trending slightly down, and the market has remained relatively flat. If we get rid of all this noise, we've gone up and down 10%. Past 192 days, half a year. Sorry, I said a year and a half earlier. I meant half a year. Half a year, the market's remained pretty much flat. It's gone up and down 10% over the past year, or past half a year, year over year. So if we take it from here to here, we're back where we were about 180 days ago. So almost about half a year. And gold, on the other hand, if we look in that same time period, so let's just go back to the NASDAQ, and we're going to measure from September 15th of 2025. Let's go look at gold. September 15th, October, November, September, okay. We'll say it's like right here. Now gold, on the other hand, keep in mind the market's been relatively flat. Gold, on the other hand, has gone up 20% while the market's been relatively flat over those same 180 days. So what that's telling us is that capital is rotating. What does that mean? Capital, so money, I don't know. It's not a very eloquent way to put it. Anyways, capital is more like, I guess, a term a big money mover would make. Someone who makes markets, someone who has tons of money, institutional investors, capital, whatever you want to call it. Capital is rotating into risk-off assets. Gold is the only tier 1 universal asset that doesn't have to be backed by anything. It has intrinsic value. Stocks, on the other hand, which are priced in dollars, in some ways are only as valuable as the money that they are denominated in. So you can see over the past 180 days, the market's actually just remained completely flat. You can see gold's gone up 20%. Another way to visualize this is if you take the NASDAQ, so that's this index, and then you divide it by the price of gold. So we'll go here, and we have something very interesting. Let me turn off my drawings so you can kind of see. We're going to hide the MACD and the RSI so you can really get a look at what's happening. If we take the NASDAQ and we divide it by gold, you can see we've had two major inflection points as of late. We had one in December of 2021. Let's go on a larger scale. And we had one in June 2024. Now you can see over this course of time, if we zoom out even further, the market, their overall market, if we go back to the NASDAQ and we look on the same scale, the market is clearly going up, obviously. Easy to see. But if we go look at the market when we price it in shares of gold, when we price it in units of gold, the market has actually remained flat. So that's something very, very interesting when you think about it. When we price equities like the NASDAQ in units of gold, it's remained flat because gold has gone up so much. When we price the NASDAQ in dollars, of course it's going to be going up because they keep printing dollars. Well, duh. Of course, your shares, which are denoted in a currency that's inflating at a rate that's almost hard to comprehend, of course the market's going to go up. It's almost obvious. So does gold as well in a similar fashion. But what's really interesting is this trend right here. So let's kind of zoom out and look at the larger scenario. If you're a fan of history, you'll know back here in April and September of the year 2000, there was a thing called the dot-com bubble. In that period of time, tech stocks were taking off. Everyone thought tech stocks were the future. You had ridiculous valuations on these companies, Pets.com, Beanie Babies, all that shit. What happened then? Now again, we're pricing the NASDAQ in shares of gold. We had the dot-com bubble. It went down. 10 years later, around 08, 09, we had the housing market crisis, and then it went down even more. Since then, we've experienced a recovery, but check it out. We're in a period of super hype tech stocks and all that crap, and to me, it looks like we are reaching a relative high once again when we compare the tech stocks to gold. Now remember, gold's the only tier 1 asset that has intrinsic value. Tech stocks go up and down all the time, as you can see. So really, what's interesting, if you take a look at basically 2017 to now, that's 10 years. The market's had a lot of time to go up in terms of dollars, but if you price it in terms of gold, it's done absolutely nothing. And as soon as we break this support line right here, around the 5-to-1 ratio, it's going to be a slippery slope. I predict a repeat. And a lot of people have said this is going to happen as well. Here's our case scenario. We're visiting here and here again. Maybe even down here. The historical precedent's already there. Maybe here, something. Right now we reached, our local high of recent past decade was a ratio of about 9-to-1. So 9 NASDAQ per 1 ounce of gold. We're sitting at about 5-to-1 now, which is the same levels we were experiencing in 2017, 2018, almost 10 years ago. So to me, it's very clear what's happening. Tech stocks go up, they boom, and they bust. So, here was that most recent bust, that was the COVID bust, but if we zoom out again, so there's the dot-com bubble. Tech stocks didn't, get out of that all-time high it made in the tech bubble for another, 16 years? So what's to say this line isn't carried over here? What if we have some sort of local high up here, and then it has to revisit these levels that it was back in 2021? There's nothing saying it can't do that. We have a historical precedent of it crashing and having to correct over the course of a decade and a half. We've pretty much had, 10 years of sustained gains on top of the last local highs. We're thinking in terms of generations now, So there's nothing saying it can't revisit this or this or this or this or this. We've already seen it do things like this before. So I think I've made my point there. Let's take a look at silver. Silver is really interesting because if you see right here, we had this very beautiful cup and handle that many people have pointed out. Cup and handles are really nice chart structures. They look awesome. Anyways, this cup and handle is a generational long chart pattern. Take a look at this cup and handle on silver. You had this structure start forming really in the 70s, mostly due to Nixon taking us off the gold standard. And you had periods of long consolidation and spikes. Only very recently, in 2025, did we actually break out of this cup and handle. Just here. So if we zoom out, we are right here. And people are getting upset that silver's at $70-something because it was at it was at like 120. Think about what this will look like if you really zoom out. You know, it's kind of hard to comprehend. Silver's direction is this way. Same with gold. If we look at gold and we zoom way out, gold's even more strong. You can see by my big arrow up here that you're pretty much just going to continuously march up. You'll have periods of correction, but to me, all of this kind of feels different when you look at what the dollar is doing. So let's go look at the dollar. Where did I put it? Oh, Federal Reserve debt system there. That's where. Okay, let's go look at the money supply. Let's go look at the M2 money supply. Wow, would you look at that? It just goes straight up. And up and up and up and up. And what is this money backed by, you may ask? It's backed by nothing. It's backed by debt. These are all IOUs. Every Federal Reserve note is an IOU. We had one little tiny period of tightening right here where the Fed said, oh, let's stop printing. Would they do that for like half a year? And here we go. So, you know, of course stocks are going to go up in number-wise if you just keep printing money. This is why you can't go buy eggs or gasoline, but the stock market's still booming and every AI tech bro's got a Bugatti. So this is why there's this huge disconnect, because, you know, if you base everything off your tech stocks, of course they're going to keep going up. Most of these are US companies. I don't know if that makes any sense, but I'm trying to put it in like kind of like normal terms. So let's look at the total public debt. What is this? $38,514,000,000,000, $9 million. $38 trillion. So obviously that's never going to be paid back. Clearly. And we just keep printing money. Clearly. So, well, yeah, tech stocks are going to go up. And sure, Amazon's going to keep going up. Look, Amazon's chart looks a lot like the money supply. Just goes straight up pretty much. You know, all of these companies have access to lines of credit. So, you know, they could be sitting on, who knows, Amazon could have $1 billion cash or more. But they're not even going to use that cash. What they're going to go do is do the same thing the federal government does. They're going to go take a loan and they're going to create money out of thin air. So the whole system is propped up by all of the big players continuing to do the things that they've always done. Intrinsically, there is nothing going on here. I mean, there's stuff going on, but you know what I mean, right? They're just going to keep printing money. So of course your stocks are going to go up. You know, it'll experience periods of correction. Obviously, we've seen that. Like if we go back to, let's pick one that's been around a while, Union Pacific. Union Pacific is a great stock. This is a stock I would love to buy if the market truly crashes and we revert to some sort of mean down here or down here. This is a great stock. Let's look at some not so great stocks. If we go to, I don't want to show you those. If you're still with me at this point, congrats. You've made it past the 17-minute mark of me rambling. Let's look at some crappy stocks. I think I deleted a lot of them. No, Pepsi's pretty good. Bear with me here, guys. These are all great. Like, you know, Nvidia, obviously, it's just going to keep going up. AT&T, here's a not so great one. Here's a bit of a stinker. AT&T, and this is why the NASDAQ 100 has remained flat. You have big companies like AT&T who have never recovered from their dot-com bubble. Look, AT&T is making a local high at a value that's approximately 32% less than what it was able to reach at the peak of the dot-com bubble. To me, AT&T is most likely going to cap out around this level and then continue this ever so slight downward kind of pitch right here. It's probably going to get squeezed in between here and here. Maybe like way out here in the future. You know, if we just continue this trend line, you could see the price do something like this and then pop back up. Or it could do the opposite and go this way. But this kind of shows why not every stock is just going to keep going up even if you keep printing money. Let's like look at the price of coffee, for instance. Here's a commodity that we all use. Oh, come on. We zoom out. So commodity, you know, I don't have that much data on it, but clearly the price has been going up. Here's cocoa. Oh wow, that crashed a lot. Interesting. I wonder why that happened. Cocoa cash contract. Anyways, guys, the point is stocks mainly go up because they just keep printing money and they keep taking on more debt. Eventually the cards are going to fall again and they'll reset the system. They'll, you know, give a bunch of pardons to themselves. Something will break and then they'll fix it in the only way that they know how to do, which is print more money.
So my advice, all this, take it for what it's worth. Buy something that they can't touch. You know, they've recalled gold and silver multiple times. Back here in 1933, FDR made it illegal to own gold. And then over here in 1971, you had Nixon. Okay? There's no reason they can't do it again in 2027. So time and time again, they've tried to take silver and gold away from you. So that means something, you know? Truly, that means something. So I'll kind of leave it at that, guys. Thanks for joining. If you made it this far, congrats. Peace out, guys.